What if I told you the single most powerful factor driving the entire Southern Ontario housing market right now is pain? Not the traditional pressures of supply or demand, but the sheer, agonizing financial pain of affordability. For nearly a decade, Southern Ontario, from the dense metropolitan areas of the Greater Toronto Area, GTA, where average prices still hover near the daunting $1 million threshold, to the rapidly expanding regional centers like Hamilton, Guelph, and Kitchener-Waterloo, was universally recognized as the undisputed, high-octane epicenter of Canada's housing boom. But 2025 has unequivocally delivered the region a crushing, protracted hangover. The current consensus among all authoritative forecasters, including the Canada Mortgage and Housing Corporation, CMHC, the Canadian Real Estate Association, CREA, and the top economic departments of major chartered banks, is perfectly clear. We are absolutely not forecasting a sudden, catastrophic 2008-style market crash. Instead, the market is locked into a deep, painful, and necessary correction. While the national average home price across Canada is predicted to experience a relatively modest decline of 1 to 3%, analysts are unanimous that the price drops will be significantly steeper and more sustained in Ontario and British Columbia, the two provinces most burdened by historically egregious pricing and acute affordability crises. We have already seen the benchmark home price in many suburban areas fall by over 20% from their euphoric peak values recorded in early 2022. Yet, despite this massive decline in dollar value, homeownership still feels hopelessly out of reach for the average prospective buyer, especially first-time entrants and young families striving for stability. The reason is simple, yet devastating. The relentless, aggressive series of Bank of Canada interest rate hikes over the past few years has effectively traded one affordability crisis, unprecedented price growth requiring massive down payments, for an equally paralyzing one, crushing monthly mortgage payments. Even when a buyer secures a home at a lower sale price, the cost of servicing the mortgage at 2025 rates remains prohibitively high, often consuming over 50% of a typical household's pre-tax income. The simple, brutal math dictates that stubbornly high home prices, combined with elevated interest rates, translates directly into a paralyzing monthly cost barrier. This dynamic defines the 2025 market as the affordability avalanche, and it is not only freezing out a new generation of buyers, but is actively crushing the financial confidence of existing homeowners facing onerous mortgage renewals and disheartened investors seeing slim to negative cash flow. This correction is a necessary rebalancing of the market's overheated core, but its immediate impact across Southern Ontario is widespread financial stagnation and despair. Imagine an entire regional market transforming into a massive, overstocked warehouse, forcing desperate sellers to slash prices just to clear shelf space. That precise scenario, the inventory trap, is the 2025 supply crisis unfolding across Southern Ontario, a force that has decisively shifted the power dynamic from the seller's advantage to the buyer's for the first time in over a decade. The market has undergone a fundamental flip. It has transitioned from a high-pressure environment characterized by frantic bidding wars and reckless unconditional offers to one marked by caution, calculation, and mandatory negotiation. The key metric universally signaling this power shift is the sales-to-new listings ratio, SNLR. When this critical ratio drops and sustains itself below 40%, it is the definitive statistical indicator of a genuine buyer's market, meaning that the rate of new supply entering the market is overwhelmingly outpacing the rate of sales. Throughout 2025, Southern Ontario has not only dipped below this 40% threshold, but has often sustained levels in the mid-30s, giving well-prepared buyers a negotiating advantage not seen since the financial crisis of 2008 or the early 1990s. What are the specific, structural factors driving this unprecedented glut of listings? Firstly, there is the devastating condo conundrum. A record-breaking wave of pre-construction condominium apartments, predominantly purchased by speculative investors, is finally reaching its occupancy and closing phase in 2025. These investors are now confronted with carrying costs and financing rates significantly higher than their initial projections, coupled with a rental market where demand, while still strong, is softening its explosive rent growth due to increased supply. Many are choosing the painful option to exit, selling their units, frequently at a loss relative to their final project costs, thereby flooding the resale market, particularly in high-density urban centers like the GTA. Secondly, there is the accelerating mortgage renewal shock. A vast cohort of homeowners, many of whom purchased at peak prices with variable rates or short-term fixed rates, are now confronting mortgage renewals at rates that are often double or triple their previous payment schedule. The increase in monthly cost is fiscally unmanageable for many households, forcing them to reluctantly list their homes. This combined, sustained injection of inventory means buyers have unprecedented access to selection, significant leverage, and the necessary time to conduct proper due diligence, ensuring they are no longer subject to the market's manic urgency. The inventory trap is a relentless force that will maintain downward pressure on both prices and the velocity of sales throughout the remainder of 2025. If we visualize the housing market as a boat, then the surrounding economy must be viewed as the vast, unpredictable ocean. And in 2025, the economic currents are highly turbulent and threatening to capsize the Southern Ontario market, adding critical layers of risk that extend far beyond the immediate discussion of mortgage rates. In the real estate sector, uncertainty is the absolute predator of consumer confidence. Economic forecasts for the region throughout 2025 are ominously pointing toward rising levels of unemployment, with the rate widely projected to peak near the middle of the year. When households experience genuine fear about job security or the loss of primary income, the absolute last major financial decision they will contemplate is purchasing a multi-million-dollar asset. This high level of labor market fragility immediately stalls both demand and sales volume. Furthermore, Southern Ontario's deeply integrated and trade-reliant economy, particularly its manufacturing and export sectors, is highly vulnerable to external shockwaves. We are currently tracking significant geopolitical factors, most critically the potential threat of renewed U.S. trade tensions and the imposition of punitive tariffs that could severely impact the region's core industries. Such an economic shock could trigger widespread job cuts, immediately and dramatically extinguishing the fragile consumer confidence needed for any housing recovery to take hold. Crucially, this prevailing economic uncertainty is directly and detrimentally impacting the one area universally needed to solve our long-term structural crisis: new construction supply. Developers are facing a perfect storm of headwinds: relentlessly high construction costs, acute skilled labor shortages, and declining risk appetite from investors means that numerous planned projects are being delayed indefinitely, placed on hold, or canceled outright. When the financial viability of new builds disappears, the supply pipeline of future housing simply dries up. As a consequence, CMHC is projecting that overall housing starts will experience a sharp, sustained slowdown specifically in Ontario, particularly affecting high-density, multifamily projects. The very mechanism required to resolve the decade-long supply shortage is currently grinding to a halt because of the compounding effects of short-term economic turbulence. While a glimmer of hope for a stable recovery might be tentatively set for the latter half of 2026, the powerful economic headwinds will fundamentally ensure that 2025 remains a punishing, low-confidence and risk-averse year for nearly all participants in the Southern Ontario real estate ecosystem. With high interest rates firmly entrenched, record levels of inventory demanding attention, and pervasive economic uncertainty defining the landscape, the pivotal question remains: if the Southern Ontario market is decisively not good for sellers and former peak investors, who is finally positioned to win? And what is the necessary long-term implication of this intense correction? The simple, undeniable truth is that the market has fundamentally pivoted away from a speculative frenzy of desperate buyers into an environment of calculated, deliberate power. The clear, immediate winners in this 2025 correction are the patient, financially solid, and ruthlessly realistic end-user buyers. These are not the fast money speculators. They are well-qualified families and individuals who have diligently saved substantial down payments and can comfortably qualify under the current, difficult mortgage stress test rules. They are the market participants who can finally negotiate aggressively on price, confidently place conditional offers subject to comprehensive financing and inspection, and entirely avoid the toxic, emotional, and debt-inducing pressure of a blind bidding war. For Southern Ontario, 2025 must be understood not as a catastrophic crash, but as a crucial, transformative moment of market reckoning. A deep, structural correction, where the highly inflated, unrealistic pricing expectations of the pandemic era are being forcefully reset by uncompromising economic reality. This market slowdown is a painful, yet ultimately unavoidable, cleansing process, purging the excessive financial leverage and unbridled speculation that had saturated the region over the last 5 years. The immediate road ahead remains challenging and full of obstacles, defined by tough debt maturity cycles, persistent high inventory that must be absorbed, enduring economic uncertainty that demands constant vigilance, and a continued environment of tough, buyer-led negotiations. While the immediate outlook is undoubtedly grim for those who purchased at the 2022 peak, the ultimate conclusion is that the Southern Ontario market is not looking good. But for the first time in years, the balance of power has dramatically shifted the playing field to a position where it is, finally, fair. This equitable, challenging, and turbulent environment is the new market reality for those prepared to navigate the rest of 2025.